Hello students, welcome to our super short current affairs series by Ravi Shankar from Ajitaha IAS Academy. In this video, we will discuss about bad bank. What is bad bank and how it is different from other asset reconstruction companies. To start, to understand bad banks, we need to understand three key terms. Most of you might be aware of it, but some of our viewers might not be aware of that. So I'm making this video from both all kinds of sections of students who have a clear idea or who are still freshers for the economics. Okay, asset means for a bank, when they give a loan to someone, for example, if a bank gives loan of rupees 10,000 rupees, it is called an asset to a bank because the person who take the loan will pay interest of some kind of a percentage. So interest of, for example, 300 rupees or 3000 rupees, whatever, we don't get into calculation now, to the bank. So until the loan is being repaid, the bank is getting interest, and this is profit for the bank. That is why it is called as an asset. Assets are nothing but loans offered by the bank. Understood? And liability. Similarly, there will be some people who have enough money and also have surplus money. They deposit that money with the banks. It is called a liability for the bank, because why someone will deposit the money simply just for the sake of security? No, the bank will give interest to those people who deposit. But when they give interest, it is like a kind of a liability for the bank. So, but in order to reduce that liability, they will give at a higher interest when they offer the loans. So let us not go into interest and all. When someone deposits money to the bank, it is called as a liability. Okay, here what is called asset reconstruction company. To understand that, we need to understand the NPA. In the earlier example, I have said that someone will take a loan, right? But the person who took a loan, if he is unable to pay that loan, he will become a default. He will become a defaulter. The loan will become a defaulted loan. After some period, the bank will announce it as non-performing asset or a bad loan or a bad asset. Understood? As a bad asset. There is some detailed discussion on that, but we don't get into that for this purpose. So if a person who took the loan is unable to pay that loan, then it will be called as a non-performing asset, bad loan or bad asset. But the primary function of the banks is to take the loan or to give loans and to take the deposits. Bank will not have the functional expertise in order to recover these bad loans and bad assets. So what they will do, they will approach some other entity called as an asset reconstruction company, which is an expertise in recovering these kind of unpaid loans. We call them in technical terms as asset reconstruction company. Understood? So these asset reconstruction companies are generally owned by the private entities, that is private individuals, but are regulated by the RBI. Means RBI will give the guidelines how these functions ARC has to work. But if such a kind of an asset reconstruction company is owned by the government, then we call it as bad bank. At least in the Indian context, the bad banks, what we are going to discuss now, that is the term bad banks, what the newspapers and all covering now, is owned by the government. How do they own it? They have created a NARCL IDRCL structure, that is a two entities. This is one company, this is another company. These two companies are joined to create one company, and this company is called as a bad bank, and the name of the company is NARCL IDRCL structure. That's it, NARCL IDRCL. Okay, we call this as bad bank at present in India. What does this bad bank does is, as it has two entities, even a bad bank can be created with a single entity, but two entities have been created for operational and governance purpose. That is separation of work. That NARCL, that is National Asset Reconstruction Company, it will buy the bad loans, it will take the bad loans from the public sector banks, for example SBI and IDB, not IDBI, Punjab National Bank, like that. Okay. Uh, so this NARCL will buy these, will buy, I am saying, okay, will buy these bad loans. That is, they take these bad loans from the State Bank of India, and these bad loans, they have to be recorded by some other entity, right? This entity is called as an IDRCL, India Debt Resolution Company Limited. In simple terms, this is the concept. Who will make profit? Why do they make profit? How do they make profit? We will discuss in another video if it is needed. But for prelims, it is not needed. The concept of bad bank is an entity which recovers the bad loans. Okay, it is simple. A bad bank whose deposits, like when I said liability, right, someone will deposit some surplus amount, but for a bad bank, the asset is nothing but an unrecovered and unpaid loan. That is why it is called as a bad bank. It is not, bank is not bad, but the assets of the bank are bad. That's why we call it as bad bank. And another thing is guarantee program. That is, this bad bank, it buys these unpaid loans from public sector banks, I have said. But these public sector banks, they don't get the full amount. That is, if the loan is about 10,000, no, just for example, okay, 100 crore loans. When these NARCL buys these banks, they don't pay 100 crores to the public sector banks. They will pay only 40 crores or 30 crores. And they will accept to pay only 30 crores. Even in these 30 crores, they will pay only 10 crores in terms of cash. Remaining 20 crores, they will say they will give in terms of securities. That is, they will give some kind of a bond paper today, and in the future, if they are able to recover the some amount like this, out of 100 crores, if they are able to recover 50 crores, they will pay this remaining 20 crores. That is why they will give securities. But who will give the guarantee? What if they are not able to pay? The government will say, I give in as a guarantee. Government is giving guarantee that if the bad bank does not pay, I will pay that 20 crores. That is, for the 5 years they will give. Okay, only for the sake of the 5 years they will give. Don't go too much details. The concept we need to understand is, there is a guarantee program which is being by the government. Okay, the prelims, they will say that there is no guarantee program, or they are unguaranteed loans. That kind of terms they will use. So we should say that there exists a guarantee, and it is a two entity structure. A bad bank. What is a bad bank? A bad bank is a company which buys the bad assets from the public sector enterprises, public sector banks, and it is being guaranteed by the government. That's it. Thank you so much. And if please like, comment and share our videos, and subscribe to our channel for more videos. Thank you so much.